From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. Welcome to the Macrocast. Tony Fratto, New York. John Fagan, Brendan Walsh from our partners at Markets Policy Partners with us, and the great John Dick from CivicScience, coming from the confluence of the Three Rivers in Pittsburgh, Pennsylvania. John, great to have you with us today. Big week, we had we had what eventually became a peaceful transfer of government. Didn't look like it may be peaceful a couple of weeks ago, but it turned out that way. We swore in the 46th president of the United States, Joseph Robinette Biden, on Tuesday without incident, and a very successful inauguration and a terrific program and a day of celebration after I think a very long and fraught election season, if not a fraught 4 years, but certainly a fraught election season. And now we're starting to see, we knew some of the people who were going to be coming in. They've had their confirmation hearings. We're hearing, getting some glimpses of how the administration is going to think about things like monetary policy. I think of Janet Yellen and I think monetary policy. I have to start thinking of Janet Yellen and fiscal policy. Janet Yellen with her confirmation hearing, she's probably going to get, I think, easily passed out of committee today, maybe even a vote on the floor, confirmed as the first female Treasury Secretary. So historic day, historic moment for the country and for Janet Yellen taking up that post. She's got views on the economy. The biggest, I think, macro question for the country, as we've been talking about for a long time, but we got a little bit more clarity from President Biden yesterday, is on his COVID plans and the rollout of the vaccines plural. Questions about whether his goal of 100 million doses in 100 days is ambitious enough or not. I think it would have a substantial impact on the economy if he's successful. We hope it's, but we hope it's he's lowballing it.
Well, especially now, because we're basically reaching the point where now half the people that are getting doses are getting their second one. So if you want to vaccinate 100 million people, you need 200 million doses,
right? Yeah. So that and then also some other restrictions, some travel restrictions he's imposing, requiring testing, requiring quarantining. We don't know what that's going to do for travel, by the way. I mean, we put safety first, but we should think a little bit about what that does. With that have a chilling effect on people traveling if you're going to have some requirement to go in quarantine, some mask wearing mandates and others. But really, it's in this next period between masking and the vaccines are going to tell us a lot about whether we can get back to normal economic activity. And then we have the COVID relief plan out there that's been, we have one COVID relief plan passed a few weeks ago that is making its way into the economy as we speak. And then we have the proposed $1.9 trillion plan by the Biden administration that is going to be a challenge to get done. And so we'll spend some time talking about that too. But John Dick, we saw more layoffs. Yeah, or not layoffs, but new filers for unemployment insurance yesterday. Initial filers over 900 million. So we're still in just a horrific range on people filing. I think 1.4 million total filing, including the topped up the PUC benefits, the extra pandemic benefits. But how do people feel about things right now? Where are people optimistic about a change or relieved, or is it too early to tell?
I think it's a mix, both mixed and somewhat too early to tell. Our latest ESI came out on Wednesday, which was a coincidence, of course, because it was the day of the inaugural. And it was down a touch over the last 2 weeks. And I think some of those job numbers you mentioned could have contributed to it. But it's also kind of impossible to decouple any of that from what happened on January 6th and sort of what that just generally did to the national mood and fear. But then with Wednesday going off largely without event, we're seeing like really early signs of positive, reaction to that. And, how that's going to play itself out over the next couple of months will be, really interesting. We saw, if we go back 4 years ago, we saw dramatic shifts in consumer confidence, both on the day that Trump was elected and the day he was inaugurated. It was sort of a, we call it now a decay shape, right? We had half of the country became significantly more optimistic and the other half became more pessimistic. For example, we knew like Hispanic consumers were instantly sort of frightened by Trump's win, and that showed up in their spending like almost immediately, right? And Target reported it later. We saw really bad movies ticket sales that following summer because Hispanics over-index as moviegoers, right? We don't seem to see, we don't expect that kind of dramatic thing, right? Because Trump was such a shock to the system. So I think we're going to see slightly more, I don't use the word conservative because I don't mean it in a political sense, but I think we're going to see more modest incremental changes in the coming months in confidence. I think what's so much more of it's going to be driven by the effectiveness of the vaccine rollout, and not just the pace of the rollout, but are these people who are sitting on the fence and concerned about a vaccine, does something shake their confidence in it, right? Are there reports of like widespread reactions and side effects and things? So a little bit too early to tell, but positive signs, at least since Wednesday, that people have a rosier outlook than they did a couple of weeks ago.
So one interesting thing that happened yesterday, which it didn't get very much national attention, and it also didn't affect the oil markets, but a place like Pennsylvania, Pittsburgh specifically. So the Biden administration put a 60-day moratorium on drilling on public lands. And it didn't affect the oil market, but stocks that drill on oil lands were down 10%. And that's a lot of the shale and natural gas. Mm-hmm. So there has been a lot of, on the regulatory side, a lot of it big things where we just, rejoin the WHO and the Paris Accord. But there are small things that have happened that haven't necessarily fed through to the lower economy, especially on the regulatory front.
But things like Keystone Pipeline being canceled in that category as well. Which...
Yeah, and for good or bad, but it's different, and it's just going to take a while for us to realize that these changes have happened.
John,
what else we saw that was sort of toward the end of the year, and again, more sort of a hope and fear evaluation than a real one with the consumer, is that we've tracked sort of concerns about tariff costs hitting household expenses, and that's sort of kind of stopped, right? I mean, I think people feel like that was more endemic to the last administration, and presumably they feel like some of these tariff problems are going to go away. And again, I hope whether they do or not, you guys are the experts on that. But I think the consumer has sort of rationalized that some of that may change and for the better. There's just a ton of moving parts. Right?
Yeah, I'm interested to see some of the. We know that a lot of these views are tribal, totally. and so it'll be interesting to watch over the next couple of months as to whether there's a shift on these things again.
Right. Yeah. But on the China front, everybody that has testified, whether it's State Department or National Security, we're not backing away from the tough China stance. In fact, I think we might be ramping it up a little bit, but I don't think we're going to do it through tariffs. We're going to do it through a much more
we're not going to do it through calling names and while at the same time punching our allies in the face. I think it'll probably be a little bit more processed and nuanced and predictable than.
And it won't be on Twitter. Yeah.
It would be hard to be less multilateral, but certainly President Biden has said in his remarks on China policy that he would be engaging our allies specifically. They've been cagey on the tariffs. We're going to review these and talk with our allies first. The statement he made, however, about the U.S. needing leverage in its dealings with China suggests that they aren't going to just flip the switch and just roll these back. This is a change in style and prioritization rather than policy direction. The grand campaign to counter China's ambitions on a variety of different fronts, we think will certainly continue. But just back to the consumer situation, the the inveterate optimists, consumers adjust in a different way than Wall Street. Wall Street is, they're always trying to jump a few moves ahead, and the inveterate optimists in the equity market have priced in an enormous amount of good news. And there is, all four major indexes in the US, the S&P 500, the Dow Industrials, the NASDAQ, and the Russell 2000, all tagged record highs on inauguration day. Wow. And, there's a sense that there's markets have clearly priced in a lot of good news here. They've priced in a lot of stimulus and a lot of continued monetary accommodation and so forth. But there's, whether it's a, kind of a sell the news, whether it's a grappling with reality, it's the assumptions about the vaccine rollout from here being smoother and having a back half recovery, the assumptions about the big numbers for fiscal stimulus coming down the train. These are probably going to be revised. And if they're going to be revised, in the fiscal column, it's probably going to be revised lower. I know, Tony, you've said you think this 1.9 trillion American Rescue Act is going to end up being closer to $1 trillion. Yeah. And that's going to be a sausage making process.
But you do think we get $1 trillion?
Isn't particularly edifying to confidence necessarily.
I think we do. I think we do get $1 trillion. I do. I think there's
or $1 less, so you don't have to say the word trillion.
Maybe, yeah. that's maybe more like it. It's still going to be substantial. I mean, we should not. And
do you think that's a bipartisan?
I think it's going to take
vote in the Senate.
I think it's going to take some work, and I think they look. I think they have a lot of things in there to trade away. I think to me, like the stimulus checks are one, are something that I think can be traded away, and traded away in the sense of they could super target the checks. I know that they sort of fade out at a certain amount, but there's nothing magical about $2,000 except that, Trump decided he was going to be in favor of $2,000, and so so Democrats are able to put Republicans in a position to be defending $2,000, but I don't even think they feel that, that they feel that strongly about it. I think same with state and local, there are questions about whether it's the right amount, how it's distributed. State and local are getting money in other ways also, including through money for, for hospitals and vaccine distribution and education. And there are other pockets in there for them to play around. And I believe the administration, as they say, they didn't start with 1.9 trillion and then try to fill up the bucket. They put components together that they thought were needed, and it added up to 1.9 trillion. And I say, yeah, except for that 2,000. The additional $1,400 checks to get to 2,000. I think there's a lot of room in there, and I think there's a lot of room in other parts of it. The 900
the minimum wage. I think that was thrown in there, knowing that you're going to negotiate that away too.
Yeah, and you can't do that in reconciliation,
right? Exactly.
That's where you end up doing it. So I do think there are things in there for them to negotiate on to get some of the loaf, if not all of the loaf. There's also going to be a regular budget process, coming up also, and I think a lot of this stuff is going to come to a head in March when some of the benefits run out, especially the unemployment insurance benefits are going to run out, and so that's where you come to a head. Well, budget coming up and unemployment benefits, and I think there's a lot to negotiate on there. The fact that they control the floor puts Democrats in a position to get something substantial if it's not exactly this. Yeah. And their problem isn't Republicans. Their problem is Manchin and Tester and some others who see it as a pretty rich stimulus too. And that for me to say that, someone who's been like for months and months and months pushing for big stimulus, I'm just saying like that's where they are. It's it's going to be tough.
And this one needs to be timely because this one is COVID related. Yeah. So it almost doesn't matter exactly what's in it, because later you can do what the big stuff you want in reconciliation, which takes a long time. This one you need to get out the door yesterday. So basically go to the 10 senators, Republican senators are going to vote for it, say, what do you want it to be? And almost just write the check.
Yeah. That said, markets are like, they just see, money coursing through the veins of the economy, don't they? And they should be optimistic. They should, we've talked about this many times and emphasize it again. There are parts of this economy that are in a depression, really bad place. And like that is, John Dick has talked about two economies, and that lower leg of the K is not doing well at all, and they really need and deserve the help. That said, we don't have a macro problem. Like we don't have a growth problem. We don't have an output problem. We have acute problems in really important parts of the economy. And, if you're going to get to 100 million doses by the end of spring and, 200 million doses by the end of the year, it's not hard to see that, you should be optimistic about the future. Couple that with, a couple $1 trillion in additional spending over prior years, should be optimistic. The market is, right, John?
Oh yeah, it definitely is. And the question is, even the optimists can look at some of the valuations now and some of the the distance we've traveled. We saw earnings season begin last Friday, and the big U.S. banks had run up enormously in the fourth quarter. This is just an example. This was, these are mature companies, and the ETF of major U.S. banks was up 50% from October to, and the earnings came out. They were really pretty good, and the stocks, of course, sold off because, even good earnings and solid numbers with a run up like that, it's really hard to justify maybe the next leg higher without, backing up a little bit. I'm not saying that the markets are going to fall, spiral downward, but even among the optimists, there's a sense that, to go back to continue powering higher, you might need to take a few steps back. And that's, we've seen that just in the first quarter. There are bad seasonals around first quarter trading. We've seen that dynamic a lot, whether it's driven by fundamentals or some happenstance in the first quarter, and then the market corrects itself and then goes higher again.
But it's hard to be too negative, because right now 75% of publicly traded stocks have a higher yield than U.S. Treasuries. So it just makes sense to own stocks, in there, even if you're just trying to be safe and just have a dividend yield.
Hey guys, let's take a break here. We have FOMC next week we can look forward to, and so let's talk a little bit about where the Fed is in this and how they're seeing the future. You're listening to the Macrocast.
Every 2 weeks, HPS measures U.S. adults' feelings and expectations for the economy. The HPS CivicScience Economic Sentiment Index accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us through HamiltonPlaceStrategies.com.
Now we're back on the Macrocast. Fagan, we got FOMC next week. I don't know how a Fed, you keep hearing people talking about inflation out there. I don't see inflation. I would love to see inflation. I think they would love to see inflation, but throwing $1 trillion or $2 trillion into the economy, at least you have to at least have the conversation about it, don't you?
Well, I think the Fed is having the conversation. Whether they're having the conversation in public matters a lot, and we saw that play out over the past couple of weeks. It was early January. There were some particularly regional Fed presidents coming out and talking about how their outlook had brightened up and how they're expecting the economy to be much better in the second half of the year, which would allow them to unwind or begin to taper, the magic word there, some of their extraordinary policies, particularly the asset purchase program. This was not necessarily received all that favorably by financial markets, given the fact that the Fed had just set their asset purchase program basically in kind of a set it and forget it formulation in the December meeting of $120 billion per month until further substantial progress toward their goals. And as we said last week in the Macrocast, the economic conditions have gone the other way, they've deteriorated since then. So it's a little bit odd to be coming out, and it was a little bit of a tonal dissonance with some of the other Fed communications. And we saw Governor Brainerd, we saw Vice Chair Clarida, we saw Chair Powell come out and really subsequently emphasize that it's way too early to talk about stimulus. They did a lot of that communication last week, and hammering home the point that we've got to get there first. And so the Fed is very cognizant of the fact that this, the back half of the year may look very different, but you don't want to start flashing forward. And that, because markets start to discount that, and you can begin to work at cross purposes to your own policy if you begin to, riff about tightening and speculate about perhaps we could do it as early as the summer. Well, as we saw in the taper tantrum in 2013, when Fed Chair Bernanke started musing about the timing of the taper, well, the market started pricing it in and tightened financial conditions, a lot would argue, prematurely. And Fed officials have come out and said, we're not going to make that same mistake again. So our view is that, the Fed is really going to stay on message here in the upcoming meeting. It's going to be a focus on the near-term challenges and how policy is going to be continued in a very ultra accommodative way to build that bridge to what we hope is a recovery. But as you said, the inflation targets and so forth, just not close to them. So it gives the Fed a lot of justification to keep things going. And what they're seeing in the markets, we've seen a lot of garbled messages from macro, and I'm interested in talking in asking John Dick, this second wave, how have things changed among consumers, the consumer perceptions and preferences as the pandemic has dragged along here? And as we're getting, to the end of the first full year of this, what trends have altered themselves in the consumer space?
Well, I mean, sort of from financially, probably one of the biggest shifts we've seen, which makes some sense actually, is we've asked people fairly explicitly, if you've got more stimulus, what would you do with it? And we've watched closely sort of the people who say I would use it to pay down debt or spend it on necessities, and we've compared that to people who say they would save it or invest it. The gap between those two groups was about 6 percentage points in July, with the higher percentage being the people who said that they would use it, spend it essentially. That gap is now almost 30 percentage points, right? So we've seen those, so that the gap between, we've seen a significant increase in the people who say with more money, they're going to pay down debt, pay for bills, pay for necessities, and the percentage who said they would save it, put it away, has gone way down. That's just a cry for it to happen as soon as possible, right? Because, and frankly, like, that group of people who say they would save it, they shouldn't get it, right? I mean, now we are not going to go out and target those people, but I do think a significantly more precise kind of surgical approach to distributing stimulus makes a ton of sense, because we do know that there are a lot of consumers who are just way better off financially than they were a year ago, because if they kept their job and they kept their income, you think of all the spending categories that were completely wiped out, those people are sitting on piles of cash, right? Pent up too, right? So for those people to get another $2,000 is, maybe a wasted $2,000. But some trends in just consumerism that have either accelerated or tapered. We are seeing things like cord cutting sort of slow down. It's getting increasingly fragmented because HBO Max and Disney Plus have grabbed a bunch of new people, but then they're worried about churn because we saw what's happening with these smaller streaming services is people are jumping in to order like one show that they want to watch. So they sign up for a trial, they watch that one show, and then they phase out. That there was this perception it was going to be this huge threat to Netflix. It just doesn't turn out. Netflix has such staying power. Drinking, cannabis and CBD usage is up. This is the lowest percentage of Americans that participate in dry January that we've ever seen. Right? It's sort of like, so this is not the time to give up drinking. I think a lot of people are saying. Sex is way down. I'm going to blush if we get too deep in that conversation, but we do track the rates at which people are having sex, and it is significantly lower than it was at the beginning. What's that, Tony?
How does CivicScience do that?
What's that?
How does CivicScience do that?
We pretty much ask straightforward. How often?
People tell you.
What's that?
And people are honest about sex.
Yeah, well, I mean, it's anonymous, right? When we give them an answer, we give them a choice not to answer, and we sort of pace those people out. We get into more detail than just how often, but this is not the appropriate venue to get into that.
It's not. That is, well, I guess you do see changes over time. So,
sure. Well, and that's it. It's really directionally, and more again. I mean, it's a proxy, I think, for people's mental health. We're looking at like levels of stress, levels of anxiety, levels of happiness, right? And those things are all correlated with self-medicating, with other kinds of stimulus, as it were. And we've seen some degradation in all of that stuff. It's just people are getting tired and worn out. And it's like, and hope, ideally we'll see optimism and hope arise as we have increasingly successful onboarding of the vaccine, and maybe those things will all start to improve.
Do you have I mean, I think it's going to be steady as she goes next week, right, guys? I mean, more messaging on the outlook, but we're not expecting any kind of change out of FOMC next week, are we?
No, not really. It should be steady as she goes. They've really set it and forget it on the policy front, and the economic data hasn't shown them anything
that they didn't already
anything
know.
Other than deterioration for the most part. Labor markets look still increasingly stressed. We're going to get the core PCE prices index next week, which is the Fed's favored measure of inflation. So that'll be interesting. It's expected to stay very tame. They're targeting that average of 2%. So coming at 2% from above is where they eventually want to land it.
Not just a point in time.
Yeah, and the latest is 1.4%, and it hasn't been above 2% persistently for quite some time. I think it spent some time above 2%, that gauge, in 2018, but it's not something that is necessarily the norm.
And also, it's somewhat interesting in the way that the PCE is, and it's also the CPI is computed for the shelter component, which makes up about 20% of PCE and 40% of CPI. We don't measure how much your house is worth. We measure how much you can rent your house for. And it's also heavily weighted to the urban areas where rental prices have plummeted. So just from a pure methodological standpoint, it's very difficult for the core CPI and PCE to get above 2% for a while.
If let's say and I mean the hard part if you're the Fed, right, is it's hard part for all of us is just thinking about like how this plays out in the future. What let's say you get you got this existing stimulus, you've got another stimulus coming. What if reopening looks like? I mean, is it? I mean, is there the possibility that we see the kind of economic activity that could get them rethinking about, rethinking the future? Are they really going to sit there and wait till they see backward-looking inflation to set them? I know what they've said, but it's a really hard thing to do, wouldn't it be? I mean, if you saw like this much stimulus coming and then some return to, economic activity.
And that's what Bostic was kind of, he went down that path. And he wasn't trying to say we're going to tighten, but he was trying to be optimistic and saying, this is kind of unprecedented times. And the only other experience we have was 1918. And then the roaring 20s kind of came. So things could be great and much better than we expect. But I think we want to be optimistic, but then don't say we're going to immediately tighten.
Yeah, I mean, we've seen futures markets pull forward interest rate hike expectations on the basis of this kind of commentary from Fed officials. So their commitment is not a commitment. It's certainly less than written in stone. And so there is going to be doubt about it. And it's going to be incumbent on the Fed, if they want to hold the line on these policies, to continue to hammer that message home. There's a sense that if you've got this big, huge bungee jump rebound where you snap back higher in the second half of this year, that's going to be fleeting. I expect that formulation to feature pretty prominently in their communication efforts in the second half of the year, assuming we do get a big bounce, which is, this is temporary. This is pent-up demand. We expect it to play out, and we're focused on 2022, 2023, when we expect the economy to normalize. And there's still, and Janet Yellen said this in her confirmation hearings, there is deep scarring, permanent scarring in the parts of the economy that the Fed and the Biden administration are now just most specifically focused on: the lower income and less and service industry jobs that are still going to be in very much.
And I think that's to me, that's the hardest part of this, right? I mean, so I guess it seems like esoteric, right? About like what does it really mean about the Fed's commitment to future policy activity, and it sounds like fun academic discussions, but you have to bet on success. There are two problems. One is that you want to bet on success, right? Like you've been talking about the fact that if you were at the Fed, that you've needed this the fiscal handoff, like you need the fiscal side to pull its weight. Well, if the Fed is doing its full nearly pedal to the metal, and now fiscal finally comes in a much bigger way. In my word, not just about this second COVID bill, but potentially infrastructure, and just increasing on the baseline budget items also, and continued automatic stabilizers. Like there's a lot there. There's no this economy is gonna be fully supported on the fiscal side, I think. But you have two economies, and the Fed's blunt instruments, address the whole economy,
right? Yeah,
but don't necessarily not necessarily do enough for that bottom leg of the K, while they're overdoing it for the top leg of the K.
Right. Yeah, it's that. How do you keep how do you keep markets from going completely insane to the upside if you are targeting your policies at a specific part of the labor markets that just need an absolute enormous amount of healing?
Yeah.
And how do you keep
that's why you need
so then
but that's what begs the question for me. It's not a question of like, am I worried about inflation? I'm not the inflation bug. Like would love to see some inflation. What I'm worried about is just the imperfect nature of the tools that the Fed has, that really ought to be things that that happen on the fiscal side. Now it looks like we're going to be getting them on the fiscal side, so we should expect to see the Fed step back a little bit while fiscal does its part. And
well, I think that's the big question. There was a sense after the global financial crisis that the Fed and the Treasury were insufficiently aligned in their policy outlook, and there was a sense that the Fed, basically the fiscal side came in, so the Fed got to do less. That was basically the formulation, which was fiscal came in, and now the Fed can start to unwind some of their policies. I think the sense is here that the Fed and the Treasury need to row in the same direction for longer. And that, the stimulus, the sort of other side of the coin of asset purchases, isn't just that it is easing monetary conditions, it's keeping interest rates low. And
right, but what I would argue that's different from that period is fiscal did not come in as big as was necessary, like way undershot what was necessary. And B, you were dealing with an economy that was dealing with significant credit impairment that is really hard to rebuild. We've seen a credit crisis after credit crisis. Credit impairment is very difficult to deal with. We have this existential threat to the economy, which is the COVID, and we may succeed in defeating COVID by mid to later in the year. So it's, it's just, to me, it's just, this is an open question that, we need to sort out what, or the Fed is going to need to sort out. And we'll keep our eyes on them and see what they say about that. It's just like, there is a logic to it. And they could just say, our measures, as they've said, our measure is going to be price stability, and reaching their price stability goals. They could do that. It does make you wonder whether they are, whether they're overheating part of the economy. That's all, and again, like, I just think it's you have this uneven impact with the Fed this isn't just like a normal economic downturn. This isn't a business cycle recession. This is different than other things. But we'll see. We'll find out. And we'll get to hear some of that from Powell at his presser next week that we'll get to talk about. John, Dick, anything else for us to be looking forward to?
Well, you were just talking so far over my head. If you bring it back down to my level, you're going to get the bends. So we'll look. I think the thing we'll watch.
When are we traveling again, John? That's what I want to find out.
Second half of the year, we hope. I think the one thing we'll watch and God willing, you have me back on, we'll be talking about in the next couple of months is this impending massive shift from consumer spending on goods to consumer spending on services. It's going to be a huge pendulum that swung one direction 2 years ago. It swung obviously back in the other direction this year, where we just can't spend in these service categories, and there's so much pent up demand for it. We're seeing it in vacation bookings, travel bookings, off 6 months, a year, 18 months from now. And you think about all the residual things that come from that spending in, amusement parks and, sports tickets and Broadway tickets and all of that. I mean, it's going to come in with a fury, and that money's going to have to come out of other parts of the economy. Come out of other parts of, categories of retail that have probably been flourishing for the last, 10, 11 months. So we're going to keep a close eye on that. It's probably a little too early to predict how and when, but it's coming.
But you can be sure that you will be back on to talk about that, because that's a pretty significant story, and we will definitely want to dive into that. Guys, great week. Looking forward to next week. So we pick up from the chairman after FOMC meeting. We're going to get a little bit more granularity on the economic policies of the Biden administration. Something coming on Monday, for example, or some Buy America provisions, which will ensure that I have some things to fight against with this administration. Not a fan of Buy America. But I think we're going to get some other granularity on what their plans are on a whole range of issues. So no shortage of stuff for us to talk about next week. John, Dick, thanks for joining us as always.
Awesome.
We'll definitely see you next month. And everyone else, have a wonderful weekend. We'll see you next week. Thanks for joining the Macrocast.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.